Welcome to the Smart Property Investment Show, the podcast by investors for investors.
G'day, how you going? Phil Tarrant, host of the Smart Property Investment Show. I hope you're well. We're recording. This is our 10th year of podcasting. One of the OGs, they say, of property podcasting. I was only looking the other day, and I'm sure the team will let us know exactly when the 10-year anniversary is, but it's looming. It's just around the corner, and it's surprising how fast 10 years can happen. But that's 10 years at least of being a property investor, and property served me pretty well, which is good. I wish I'd bought a lot more property 10 years ago than what I did, and I could have, but I didn't because I was too busy doing other things. But such is the tale of most property investors. Everything told me, and everyone told me to buy more. This is back before really, 10 plus years ago, before buyers agents or property strategists was the norm. Largely it was a sector that sort of flew under the radar, and only those that knew, and they were identifying and realising that there was a new cadre of professionals out there who were super supportive of getting people into properties. It's certainly democratised now, and there's buyers agents everywhere, which is good to see the industry growing, and we'll continue to be supportive of that. The industry does perpetually change, and the way in which the industry communicates and connects these days is very different. The tools available to them to do what they do, that is finding new customers and or finding good properties, is changing rapidly, and that will continue to do so. But it's a vibrant and a dynamic sector. Unfortunate, we've been able to attract some quality operators in and around it. There's no real common pathway into property investment, particularly if you property investment advisory. People come from all walks of life into it. Some are engineers, some are doctors, some are lawyers, some are real estate agents, others are teachers, and truck drivers and all and sundry. So it is a very vibrant and diverse community of professionals in and around property investment, and it'll continue to find its way, which is good. But fortunately, I get to bring them onto the studio and have a chat with them. Not only property investors, but those people who are supporting property investors. One of them is Scott O'Neill. You might know him because I do quite a lot with him on our Inside Commercial Property podcast. But he's come onto my show this time rather than it being his show. So I'm in charge and I'm in control, and therefore I can give him a hard time about it. He's the founder, MD of the Rethink Group. Most of you know the Rethink Group through their property advisory business called Rethink Investing, but they do a whole bunch of other stuff. I'm not going to go into that today. I'm not going to give him the opportunity to plug any of his other businesses. He's here to talk about property and property investment, what they're up to, what he's seeing, what they're doing, and how we can pick his brain to probably get some advantages that you normally wouldn't get. Scott, how you going?
Good to be here, mate. The OG himself, Phil.
Me? No, I'm not the OG himself.
Supporting the community of buyers agents.
Try to. That buyers agents. I remember when you were a young, budding buyers agent. I think you were an engineer. You come from the engineering side of things, don't you?
Yeah, it was interesting what you mentioned, like the different walks of life people come from. So, like, just thinking out loud, like where buyers agents come from now, it's many different fields. But I was talking to, I met Victor the other day, one of your
Victor Kumar.
Yep.
Mate, he is one of the original property strategists and buyers agents.
I think he said he was third. So there was a couple sort of, 20 odd years ago, he was one of them. And there's a very common trait with the early buyers agents, which most of them built large portfolios and kind of then retired from their jobs. Like I was part of that cohort. There's plenty of others you talk to that did that as well. And that was the way into the buyer's agent industry before, because it's almost like you just help people do what you did. Yeah. That was a simple business model.
So you built your own big portfolio.
Yep.
And then you didn't need to work anymore. Then you
That's
went,
right.
I've got to do something. So you become a buyer's agent.
Exactly. Yeah. And now there's different avenues. There's obviously courses out there and people go do that. So it's a lot easier to become a buyer's agent. Like we all know the barrier to entry is quite low, but to succeed now, really you just need to be good on a microphone and it's almost like being a good salesman, and then obviously you've got to build a team around that. So if you're good at running a business where you can just market online and do podcasts well, like you can actually get a leg up quite quick. And I know there's many examples of people that have done that and they haven't even bought more than one or two properties themselves. So very different industry now. There's some great operators. There's some not so great, but I actually really like the fact the industry is bigger, because when I first started, my way of getting leads when I actually had the business was going to mortgage brokers and just asking for referrals, and they didn't want a bar of it at that time. I remember I had a deals of the week pamphlet, and I'd go to them.
A pamphlet,
literally paper.
Yeah.
And say, look, here's a unit block in Port Macquarie. Here's a duplex in South Australia. Like, it was all yield focused, bit of upside focused, and tell you what, the strike rate was very low. It was hard yards, and most of them just didn't want to pay a fee. That was the barrier. Like, they'd go, well, how much are you going to make out of it? And they go, well, why don't I just go to them direct? I go, well, it's off market. And it was just like a fight against the fee. Now the fee is, it's assumed. So it's a lot easier.
And, to my point, I've sort of been navigating conversations on air through podcasts for a decade, and then prior to that through sort of written journalism. I guess you're an engineer by trade. I'm a journalist by trade. I wouldn't actually say it was a trade of mine. I sort of stumbled into it, whereas I think you actually were smart enough to become an engineer. I've been talking about it for a long time, and probably one of the earlier people to use a buyer's agent versus other people. And I was happy to pay the fee. I never questioned the fee, purely because, I didn't know what I was doing, and I was happy to pay for a professional to do it. But when I started investing, the fees were like maybe $7,000 for a buyer's agent. But let's remember, back then I was buying properties like houses in the western suburbs of Sydney for maybe $250,000, right? So, comparatively, the percentage is just as high. But I was never fee reluctant, never questioned the fee. And could have I gone out and done it all myself? Yeah, sure, I could have. If I had the time, energy, effort, bandwidth, and willingness to learn about something and be a master of my craft. Absolutely. People always go to me, when are you going to become a buyer's agent, Phil? I'm going, I'm never going to become a buyer's agent. Yeah. I just, it's not my thing, but if you're willing to do the hard graft, you can become a buyer's agent. And fortunately, to your point, and you're certainly a case study of this, you could move from one particular discipline and specialisation into another discipline and specialisation. And the point is that the buyer's agent should be a professional. It's not really something you can do part-time. It would be my view, but that's not why I wanted to bring you on today. Have a chat about it, but it's something I think about a fair bit, and I'm very conscious of the growth and development in the buyer's agent sector, and I'm happy to have been part of the story of that, chatting with and narrating the growth of this sector, and I think it's still got a long, long way to go, which is cool. But I would caution a sector also to be really clear of who it thinks it is and what it chooses to do. And like most industry sectors, and I think about mortgage broking, and they go through these periods of this sort of nascent sort of birth of them, and then they go through this sort of bit of a how's it going type of sort of bit where they try and work it out, and then regulation typically comes in. And I know PIPA, for example, the Property Investment Association, have been trying to seek regulation for the sector for years. It's not happening. I don't know if it's ever going to regulate it, but buyer's agents today versus what buyer's agents will be in 5 and 10 years' time, I think will be very different things. But it's on the right pathway.
Yeah, definitely. And behaviour's changed a lot, the structure of the business. Like, I always liken it to the sales agent industry. There will always be lots of independents now, but we're now entering, it's still very early days for the buyer's agent industry.
It's usually early.
But the trend I'm seeing is the larger buyer's agents are getting larger because they've got track record, trusted. Reach is probably the most important thing. Like, I know us in the commercial space, you can't touch us in terms of our stock because we've got all the networks that have taken a decade to get there. And like, it's just hard to compete in that space. Would I start a commercial buyer's agent now? I wouldn't personally, because like just getting good high value leads and then trying to compete against agents that have got networks of fund managers to, establish operators, it's very difficult. So I look for the path of least resistance with business. There's still opportunity with residential because you can simply be an area specialist, or if you've got a different angle online, you can generate attention there and then use that attention to then buy property. But you got to be careful to, pick the right assets, because you can do anything for 3 years, but if the results aren't above average, then you're not going to have future clients. And I always play the long-term game, and I'll forego a bad deal any day of the week over the revenue, because that bad deal could destroy your business. So, there's an old saying, you're only as good as your last deal in the buyer's agent space. And I sort of really sit on that mantra because you have to.
That's what you see sort of, this next iteration of the growth and development of the buyer's agent industry is very much around And this is where I think we need a sense of caution with it. And this is for investors as well as for the sector itself, is being a buyer's agent should not be a side hustle. This is not, hey, I'll find you a property because this is the job I do outside of having another job. Like, I've got a day job and I'm an Uber driver. I've got a day job and I'm a buyer's agent. You need to ensure that you're using professionals with experience and capabilities if you're choosing to use and pay for a buyer's agent. They sit as advisor for you. You pay them good dough. I don't know what your fees are, but you pay them good dough to work for you. So you want the absolute best person in your corner. Fortunately, we have really good people in people's corners right now, and they're getting the advantages of creating wealth faster and maybe more sustainably, inverted commas, through using buyer's agents. But it's interesting times. We'll see how it goes. You're one of the old guys now, mate.
Yeah, and I sort of like that fact. And this is a call out to any of the buyer's agents out there, because we've had a lot of established operators actually reach out and want to pair up with Rethink. So
okay.
1, 2, 3 man bands or women bands, and they're basically out there finding the deals, doing the DD on the deals, talking to the clients. They're doing it all themselves. It's an incredibly inefficient model. I did that when I first started, and they're the longest hours I ever worked. But as a larger business, we segment those, departments. So people that find properties, is all they do. They talk to agents. They don't do the DD because the DD team will do the DD. They're generally on salary. The guys that are finding properties are on commission. Same with the sales. So we actually have that due diligence set up it's not incentivized to get the deal over the line for a commission. That protects the interest of the brand and the quality for the client. So if you're sort of out there and you're battling and doing it all yourself, working for a larger company might mean you can make a higher income because you can do more deals. You're not going to get the 100% of the fee like you would yourself, but you might be able to do 5 times the volume.
And I think what you're doing there is probably telegraphing where I think the industry is going. You're seeing it already with some of the more established larger buyers agents that they're getting quite significant investment into them.
Yep.
I think long term, like the mortgage industry or other industries, the buyers agency, it started out maybe a bit as a cottage industry, smaller organisations, which the early adopters and the early businesses are now evolving to something a lot more considerable and significant. I'd put Rethink into that. You've got ambitious sort of generational plans with Rethink, and I think that's great. So I think you're going to start getting the corporatisation of buyers agency, and you're going to get some consolidation. And I think you're probably going to start getting different business models emerging out of it where, yes, you can go out and do all this stuff yourself, but it's bloody hard, and you're competing against some pretty heavy hitters who have a lot of the advantages that you may not have. So maybe that's a future for buyer's agent. I don't know. Maybe there'd be some roll-up at some point. I don't know. I don't know if private equity's looking at it, but I'm sure there's some smart people having a look at how this will work moving forward. But, we're not here to talk about the growth of the industry. Well, in some ways we are, because I think I get great satisfaction the fact that a lot of people have changed their attitudes and mindsets in decision-making or approach to property investing through tuning into this podcast for 10 years and may use a buyer's agent, may not. You don't like the last few properties I've bought, I haven't used the buyer's agent. I've sort of, gone different channels with it because I can. But, it's still got a long way to go. The biggest issue I reckon you've got, Scott, is probably one of your biggest strengths as a company, is probably one of your biggest weaknesses now, is that people think you only do commercial property. Yeah. And we've sort of wrecked that in some ways because of our inside commercial property. We think, Rethink, that's the commercial buyer's agent. That's not the case. So I want to have a talk to you about that. Welcome back, Phil Tarrant, Smart Property Investment. I hope you're well, with Scott O'Neill from Rethink Group, which includes Rethink Investing, and Rethink Investing is more than just a commercial buyers agency. We've stuffed it for you, mate. You do resi. You probably do more resi than commercial.
Well, we don't advertise it because we want to remain at a level where we can support the clients. And one of the industry standards now is the big guys doing the residential space. They're getting so busy. Wait lists are growing quite large. That's what we've got with commercial. Our wait lists under 1.5 mil are quite long, and there's no silver bullet to solve that, because there's simply not that many commercial deals out there. What's changed in the last 5 years for us? Because I moved, I didn't move away from residential, but we were doing more commercial in entry level price points. But as the commercial market has grown so quick, those opportunities are just getting smaller and smaller. So it's brought the relevance of residential back more than it was. So I'm as a businessman, I'm very flexible. Like, I may not do any commercial in 5 years if it doesn't make sense. I'm not precious to any asset class. I'll go where the opportunities are. And right now, commercial has those opportunities because the yield, the current interest rate, like, you're not going to retire on residential alone. Even if you've got 5 mil debt-free residential, you're going to be sitting at a 2-3% net return. Rubbish. Why don't you put that into commercial and get a 7% net return? Multiple times better. So if you're a serious investor, commercial is a part of it. But residential, to your point, we still do it where we do pretty high volumes with it.
Yeah.
We're nationwide. We have been doing it since 2015. So we've run through the cycles. I've seen many changes from when APRA changed the rules to when COVID hit to even now the new theme in the market, which is the data-driven investment model. So data, like, we're still data, as everyone is, but we don't base all our decisions on a quick data fix, because this is one of the things I want to bring to the attention of the wider market so you don't get caught out. Data is important, but there is a risk now because I'd say there'd be over 100 plus buyers agents out there all using data. And if they say Townsville's the market to go to, that market cannot cope with even 10% of their volume. So that you can completely destroy a market in a good way if you get in first and you pump the market. And then what happens in 3 years' time once that growth cycle and then the data says, let's go buy in Adelaide or Melbourne. And as an investor, I'm more long-term than that. Like, because it doesn't make sense in Australia when you've got to pay stamp duty and capital gains tax and negatively gear for the first 3 to 5 years.
Transaction investing it's a tough game, and it's a full-time job if you're serious about it. Like, that's what you need to do.
Exactly. But this is the thing, the data-driven model makes it not only necessary, but you almost have to be transactional, because you might get a sugar hit with growth if you get in early. Then if you don't get out, and the buyer's agents, and they're on record out there saying, we will tell our clients to sell. Imagine they bought 500 properties in Rockhampton. What happens then when they start seeing that growth cycle, like, and they see, there's another hotspot somewhere else? It's hotspot chasing. And you and I have been around long enough to know that the hotspot word is a dirty word in real estate, because it will basically mean you generally will lose out long term.
Yeah.
You might have a few good years, but again, the transactional nature and the costs.
It costs so much to get in and out. Like, I don't know, if you've never sold a property, wait till you do, or you sell a couple in a financial year and you sit there with your accountant going through your finances at the end of the year and just going, how much am I paying in
You'll
tax?
lose a good year, 1 to 2 years of good growth. That's the thing. So even if you get 5 great years or 3 great years, which is more likely in these cases, you've lost half of that to your transactional costs. And then you got to go buy back into the market and pay it all over again. So
it's really funny when property investors have the realization where they sit there and just go, like, because all the narrative around property, a lot of the narrative around property investment, particularly on social media, is, I bought this property for this much and it's worth this much. Look how much equity I've created. I'm going to use that equity to go and do some more stuff, right? That's the name of the game, right? But when you actually sit there and pull it apart, and most property investors have this realization, they go, I've got all this equity, but for me to get the equity, I've got to pay more money to get the equity because I'm increasing my debt. Then I've got to use that to actually go and deploy elsewhere, which just keeps propagating this issue of like a big fat property portfolio with lots of equity in it. But one day you want to get that money out. To get the money out, you got to pay tax on it. You got to pay tax on it. Like, and then people just go, oh, really? Like, it's and you see that they deflate and get pissed off and frustrated with property. Happens all the time.
Oh, yeah. Yeah, no, the costs are terrible in Australia. And, we're not the US. We're not New Zealand, where they don't have capital gains or stamp duty. Like, it's a different market. So you need to play by the rules you're given. And, maybe call me old school these days, but the old school way of investing, I still think should be the number one way.
What's the old school way of investing?
Buy and hold long term. Sell if it's got like a bad 5 to 10 years ahead. But just buy and hold, because all my best performing assets, and I've got 70 odd tenants spread over 110 million in property. All the ones I bought 5 years or plus ago are the best ones. Yes, some have gone great in the last couple of years, but like the dwarfed rate of just compounding capital growth on an initial deposit, it's massive.
It gets to a point, it's really funny when it happens, because it sort of just creeps up on you and you expect it to happen, but you don't notice it immediately. And I was only doing some stuff the other day one of the properties that we've spoken about on the Smart Property Investment before, is a unit block up in Kalanga Way. 5 properties. We bought them for, I don't know, a couple of $100,000 each. There's $1 million all in, right? Like for a unit block, 5 of them. And I was only doing some sums the other day, and I went, wow, this thing, I've never refinanced it. And I said, this thing's actually spitting out quite a lot of money now. And I was sitting there and I went, that's pretty cool.
Yep.
You know, that's
what it's all about.
That's what it's all about. And that's probably 7-8 years ago. And I just went, so this is what it looks like.
But it's not just that. It's a good area.
It's a good area.
So you're not going out into the sticks to chase a quick bubble in growth. And that's the key message I want to leave here. Like, don't forget the long-term fundamentals. Don't get sort of hoodwinked into a situation where it's like going to be quick growth, because even if it grows 50% in a short time, like by the time you got to sell out of it, because you want to sell out of these things if it is going to go quiet for the next 5 to 7 years, you know, you might be better placed in a Sydney, Melbourne or Brisbane market, which has a lot more stability, and the buyer's agent effect or the data effect will not affect those markets as much, because there's still owner occupiers dominating the purchasing power. And I think that's more important from an overall wealth point of view.
Yeah, and this is the complexity of investing in property, which when you on face value and the veneer of it, it all sounds very, very simple, but you scratch the surface and get stuck into it. It's very complex and complicated with many, many moving parts. You know, in many ways, you know, investing in property, you're a bit of a madman or mad person, because there is so many things outside of your control. There's so many things that you have very, very little control over. You know, the economy, who's in power, what regulation or red tape is it around it, what's the money markets doing, what's coming. There's so many things out of you. You're bonkers to invest in property in many ways, because you're throwing caution to the wind. You know?
100%.
You know, fortune favours the bold.
And you brought up one, and I always like talking about this, but the regulation risk with the residential property market. I think every good investor needs to factor this in. I know I do, because I am worried over the next 10 years there's going to be more more sort of socialist type residential leasing protection metrics out there. So whether it's caps on rents, whether it's you're not allowed to boot a tenant out even if they're not paying. Like, we all know that as that population base goes to more than 50% lifelong renters, then they're going to bring policies to get votes for that asset base, or, you know, the voter base rather. So right now, we've seen examples of that in Victoria. You know, there was talk of it in Queensland. They were going to bring in a land tax that kind of looked at. So these things are going to happen.
Well, you've got no grounds eviction coming into New South Wales at the end of this financial year, I believe, and I think from the 1st of April, there's a whole bunch of new stuff, like new legislation, like things like, you know, if you don't have a dual flush toilet, you can't charge for water. You know, it's like
Airbnb restrictions. There's going to be so many different types of policies none of us will ever think about. But as time goes on and that base gets larger, then it's more likely to happen and it'll be more severe. So the way to protect yourself, spread your eggs out. Got to go different states, you know, even different countries for that matter. Like, you just don't just keep buying, like, you know, you see the people buy 10 houses in Southeast Queensland only. That what if that government does a land tax swap with something, and then all of a sudden what that will happen is it'll crash the market like it has in Victoria. And that's good for some people, but, you know, Victoria, they might reverse it. Let's say the Liberal government gets in next. So even rules that they put in place may change, but the reality is it's like interest rates. We don't know what's going to happen. So be a good investor by spreading your risk out. Like, commercial is probably one of the ones I always default to. It's going to be out of the limelight, I feel. Like, they're not going to attack commercial investors. There's just not enough of us to make a difference. So hopefully that'll be out of the mirror for them. But, you know, it may not be as well. So how do I protect myself in that? Manage debt levels, spread the risk around different asset classes, different states, different countries. You've got to put all cards on the table.
You do, and I'm a really simple. You know me long enough. I'm pretty simple, right? The best way to protect yourself in property around all these unknowns, it's really, really simple. And most people are going to go, well, yeah, of course it is. But the best way to protect yourself against all of this sort of stuff is to ensure that you buy really good assets.
Correct.
And that is the point. You sort of, you know, you mentioned the fundamentals, right? These are the fundamentals. So I look at the portfolio. I've got a number of different portfolios in a whole bunch of different sort of structures and stuff. They're all good assets. Like, you know, if the sky fell in, they're still going to be good assets. So I've got optionality. And this is my big thing on property investment. You need optionality. If this happens, what do you do? This happens, what do you do? This happens, what do you do? And you want to make sure that your worst case scenario is still a good case.
Yeah.
And typically you can buttress against that by buying really good assets. You know, if you go further out to the fringes and you start getting a little bit more transactional in your approach, to your earlier point, what you'll find is that if you mistime the market, it's really not very forgiving, and you need to build that optionality into your portfolio, that if you're contingent, your success is contingent on your ability to time a transaction or time a particular move or decision. That's when you're fragile and frail as a property investor. And I think a lot of Australians have built portfolios like that.
Yeah. And look, there is a theme in Australia of how many properties you have. Like that's one of my things I kind of chuckle at, 30 properties. You know, that to me, would a family office do that? Buy 50 houses in Caboolture or, more like northern suburbs of Perth? It's just, that's a mug's game. That's what a slumlord would do if they want to, try brag to their mates. I've got 50 houses. It's not about that. What's your net income? What's your total asset value? What's your debt ratio? What's the real situation? Don't count how many doors you've got. That's a silly metric.
Yeah.
It's unmeasurable. So we've got to get back to, real conversations. Go, how do you actually retire from this? Don't just talk about how many properties you are because it suits your buyer's agent business or, those types of things. And because, I remember seeing, in the 2005 to 2007 period where people were buying heaps of places in Karratha and places like that because the yields were great. Yeah. And we all know what happened then. Yeah. Banks basically pulled the loans in because things
people
changed.
Are still stuck, right? A lot of people are stuck. It's ruined families, some of the decision making. But this is, the critical choice and decision you need as a property investor is what is going to be your mindset or your attitude towards property investing. And to your point, should be the long game rather than transactional. And you spoke about the emergence of data, and maybe this accessibility or interpretation of data is starting to shift in many ways the sort of investor behaviour or aspects of investor behaviour. So I want to drill into that. Smart Property Investment once upon a time was a print magazine. You probably used to read it and you would have had a stack of them. Probably you would have, I don't know if you're ever in it as a young investor.
No, I think that's one of the things that there were two main magazines. You were one of them and there was the other one. And they were like my first taste of, wanting to invest, because I remember reading these portfolios, and one of them was the example I mentioned, where this young couple bought a whole bunch of properties in, northwest Australia, and wow, the cash flow looked amazing. But then I looked, they were all in the same suburb or within, or another equivalent mining town, and thinking, not going to last. What's happening? Moranbah was another one.
Probably. And you saw these everything is different, but nothing is different. This is back then. There was people pumping up these places, and they used to do it rather than potentially using social media as the carriage or the mechanism for connecting and influencing people. They used to do it through property seminars, which were all the rage. They were everywhere, right? And we used to go to property expos with Smart Property Investment, all that, with our print magazine, trying to sell subscriptions to it, right? Yeah. And you say to someone, subscription to Smart Property is $100 a year, and they go, No, I'm not going to pay $100 a year for property information. I'll go and spend $10,000 on a mentor property course and then end up buying all these properties out in Moranbah or Karratha or Port Edward or Gold Coast. Well, whatever. I said, nothing's changed. It's all still the same. But what hasn't changed either is we used to stand at like a stand, and for those people that remember these, I think there's still property expos going around these days, but we haven't been to one for years. They'd rock up and you'd have a stack of magazines on a shelf and you'd be standing around trying to flog a few subscriptions. And every single person, largely 100%, would pick up a magazine and they'd flick to the back, the property pages. And it used to be like 30, 35 pages of property pages. And all this information is still all available. You can get it on smartpropertyinvestment.com of the year. But it was every single suburb and all the data. And they just instantly they'd open it up and they go to the place they thought they should be investing, and they'd look at it and go, okay, Toongabbie, New South Wales, looked at the data. Yeah, that's a good spot to invest. Yeah. Right? So people still largely do this. They think property investment decision making is purely what the data tells you. So you either get you either have an idea and you confirm it with data, or you use data to tell you where to go. two different sides of it. You're saying that maybe the data at the moment is telling you to go to Townsville, right?
Yeah. Well, and just to be clear, I love the data. You need to use data. And I used to use those magazines as well. And my metrics back then, and it's not that different now, this is a very simple way. I'd look at yield, go, it's got to be good enough to justify it. Otherwise, I don't want to be buying into a 4% gross yielding suburb. That's just going to be too hurtful.
So resi property, like I measure yield three ways.
Yep.
You know, what it is at purchase, what is it against purchase price, what is it against the establishment price, two different numbers, and then what is it today, right? And I also measure it against debt, right? So four different ways. You know, typically yield is measured on what you buy it for and what is the weekly rent times 52 against it. So that is really the number that people use. So you've got to be careful with this. How do you measure yield?
Yeah, well, look, it's all back to gross yield in these suburbs. And I just look at what my minimum yield needs to be on a gross basis, but then you work back on a net. And this is the commercial investor where I don't ignore half the equation. You still got to go back to net returns because, and I encourage every resi investor, even to look at your current properties you've got, must go look back and go, what is the exact cash flow I'm getting? How many of these can I afford to hold? At what point do I need to either pay debt down, sell one, or reinvest into commercial to fix cash flow issues? Because there's a lot of people that are working to save their portfolio right now. And that's a risky thing because interest rates, no one knows what's going to happen. We're all saying, it might drop 1.5% to its next terminal rate. But what if things change? There's talk that interest rates may stay higher than what we've seen over the long term. So if that happens, is your portfolio going to stack up in the current market? Are your current debt levels safe? What if the banks run into a similar, subprime crisis risk somewhere in the world, and whether it's Europe, Asia, or the US? Like, are they going to change the rules with serviceability in Australia again? And if that happens, are you happy to sell 1/3 of your portfolio quite quickly? And if that happens, everyone's going to be selling 1/3 of what they've got, and that's where you have those price corrections. So that's how I think, quite negatively with property, because
but you need to,
I've got to
right?
be,
And I would say if you're new to property investing and you've only just found property investing as something you can use as a wealth creation tool, don't buy too much into this idea of creating a positive cash flow portfolio.
Well, you can't do it with residential.
You can't do it with resi, right?
And the simple thing is,
and people argue against it, but it's bloody hard.
Well, they quote gross yield. So a good gross yield, 2025 is about 5%.
Yeah.
Sure, you can go find a 7 or 8%, but it's going to have risk, like whether it's a unit block, and even those things have huge rate bills and huge insurance premiums. And don't forget maintenance. Maintenance is massive. We all know that. Both of us have large portfolios. Like, I'm always spending, feels like tens of thousands a week on something, and it eats away. Yeah. So once you plug that into your gross figures, it doesn't look great, residential, but you're there for the growth. Residential, you need to use it as basically you put your 20% deposit in, go into a growth market. Within 5 years, you've made incredible return on equity figures. Basically you deposit plus the growth on, you're using an 80% mortgage. So 80% of it's not your money. You're going to do good things if you're getting 5 to 7% per annum growth. You're not going to be making much on the cash flow, but the idea is once you've done that a couple of times, pull your cash together and then go into a larger value commercial, or, you've got to fix the cash flow somehow. And that's the big thing. You build your wealth in residential, but you have to fix your cash flow somehow.
You've got to fix your cash flow. The cash flow needs fixing, and it's very, very hard to do inside of resi.
Yep.
If you're not being too bold or ambitious of where you're choosing to buy. So back to this point around optionality, right? Like, it's very hard to buy really, really good assets in really, really good locations that are going to immediately allow you to retire off resi property. And that's going to burst a lot of people's bubble, but that's the reality of it. You can't build quickly positive cash flowed resi property portfolio if you're investing in really good assets. So you've got to work out what is your appetite for holding property and how much money you have in order to contribute to it for the capital growth. And for me, it's really simple. It's the arbitrage between what it costs me to hold. For every $1,000 I pay to hold an investment property, what's it giving me in capital growth? Yep. And that's the arbitrage equation.
Yeah, exactly.
And if you haven't got the money, can't do it.
Exactly. And like you don't need to rush to. Like people I get often asked this all the time, like, oh, how'd you do it so quick? Bought my first property in 2010, second one 2012, third one 2014. 4 years, bought 3 properties.
Yeah.
Most people are smashing me in terms of timelines. Like if you just go buy 3 houses in the buyer's agent world, some of these guys are doing 10 in 3 years. So it's still possible. But like the magic started happening after year 4 for me because equity was built and like I was working harder, I got pay rises. So like there was more money coming in and I started doing value add strategies and eventually I bought my first commercial property in 2015, 5 years after my first deal. Those timelines are pretty good for anyone to follow if you're active. And so it is all possible. You just don't keep flogging the same horse because that strategy will tire you and you're going to run out of gas. Especially now the interest rates are pretty similar to what they were back then. But remember, back then interest rates started dropping. If that happens again, everyone's going to get great equity, great cash flow. It'll be a boom town.
It'll be a boom town.
And then what happens after that? It might correct again. So you just got to be, wary of the cycles.
You'll be wary of the cycle. But I guess what's treated you well is the decision that you made to fix your cash flow at the right time because you couldn't have probably continued down that pathway, resi, to create the portfolio you got today.
And look, the banks were pushing that. Like they said, look, I'm tapping out with the residential strategy. And, we've all had those conversations where, because most people are trying to max out their serviceability because we all know property builds wealth, whether it's resi, commercial. Australia's a great place to invest because there's always more people here and the cost of building goes up. And, where the governments, both sides seem to protect the investors to a degree. So like they don't want the housing market to fail. So that's all in our favour. Things are priced higher now as well. So it means you just got to change strategies. So, one thing that worked really well for my wife and I was the rentvesting strategy.
Yeah.
We bought 20 odd properties, commercial, residential before our home to live in. And then we bought the home and that we didn't buy for many years after that. That was a massive boat anchor. Like, so once you commit to that, you're kind of out. Or if you go first in the principal place of residence, this whole thing we're talking about may never happen as well. So you got to be very strategic.
And it's a compromise as well, right? If you've subscribed into the idea of having a nice family home and occupied where you raise your kids and have the safety and security and certainty of not being thrown out because someone wants the property back, that's cool. You know, it's often hard, and I always say this, it's often hard to do both. It's really, really hard to try and do 3 things. To achieve 3 things simultaneously. It's often hard to do both, right? Yep. Both being, younger Australians saying, I want to go out and travel the world and be experienced and do this and the other and that, all that sort of stuff. That's cool. You're probably not going to be investing in property as a result of it, or you're going to be delaying your property investment decision around it. Or I want really good work-life balance and I want to concentrate on my mental health and I want lots of time to me and all this sort of stuff. And I don't want to work a full-time 9-to-5 job because that's what old people do. So therefore I'm going to do 3 gig economy jobs so I've got more time to invest in myself. Like, that's cool. Don't expect the bank to lend you money so you can invest in property. So you're going to be renting. So it's hard to do both. So back to the point around property, if you go down a pathway wanting a nice big fat owner-occupier home for raising a family, that's cool. It's often hard to actually invest in property while you're doing it at the same time, and or you got to delay that decision-making. People go on that pathway, they normally hit their 50s and they start investing in property.
Yeah. And it's probably the easiest way, and this is probably a message to all the over 55 sitting in a house in Lower North Shore, Sydney, the 2 racks, all those kind of higher price markets were above 3 million per se. I was looking this morning, I'll run through some numbers. So I was looking at the average 4-bedroom house price in Rose Bay, so eastern suburbs of Sydney, 5.25 mil. Now, to buy that with an 80% mortgage, you're looking at a 230,000 per annum mortgage bill, plus insurances, plus 10 grand maintenance. Like, I own a house, even a new one, you got maintenance. So that could be a lot larger if it's an older house, but you're in the hole for 250 grand cash flow a year.
After tax.
Yeah. And so that equates to $4,807 a week rent. Now, what if you rented that same property? You're going to be looking at the average 4-bedroom rent for Rose Bay, and it's a pretty competitive place to rent because it's next to Bondi, so you've got a lot of people room sharing and stuff there. So it's $2,500 a week rent. that equates to 130,000, which is not 130,000 rent costs. But you basically then, what if you use the deposit that you were going to buy that house?
How much of the deposit would have been? A 5.5? That's
80% of that.
Yeah.
You're going to be looking about 1.4 total by the time you put stamp duty, your 20% and solicitor costs, other purchasing costs. So 1.4 mil. Let's say you put that 1.4 mil into a commercial, getting a 7% return. So that'll give you about a 3.5 mil total spend cost. For both the equations on the house mortgage and mortgage for the commercial, I'm just using 6.25%. So you're going to be collecting 245 grand income on the commercial property, but then you've got to pay your mortgage on the 70% mortgage. So you're going to be left with 91,875 bucks a week free cash flow. So almost 100 grand income from the commercial purchase. So what you do is that initial 130 rent that you were paying in Rose Bay, you've all got a positive cash flow of 91,000 as well. This is before tax, but there's very good depreciation benefits. Often they cancel themselves out and you're actually ahead with commercial, but you're left with 38 grand a year net negative position to rent a 4-bedroom house in Rose Bay after you bought a commercial property. So you're renting that house for $733 a week, and that was versus a mortgage of $4,807 a week. So it's a $200,000 swing in income. So you think about all those empty nesters who are sitting on these much larger deposits than that, most likely. What if you just sold your house, deposited it into a commercial asset, and then rented? And like we all know, laws for renting is pretty flexible. You can sign long leases, you're protected. They can't just boot you out.
Well, no grounds eviction.
You've improved your cash flow by 200 grand instantly from a trade out into a trade in. And then you're renting. It's pretty good going.
And that doesn't assume any of the capital growth you're probably going to get or you should be getting inside your commercial property.
Yeah, look, and that's the other side of the equation. Like your house, if you bought in Rose Bay, you're going to be getting, 5, 6, 7% per annum on the 5.25 million. Your commercial, you'll be getting similar growth rates, but on an asset base of 3.5 mil. So there's going to be a little negative, capital gains benefit due to leveraging less, but maybe you don't want a giant mortgage of 80% when you're 55 plus, or even starting out as an investor.
You might be able to deploy
too much
free cash flow to your kids to get them into the market. What people would say is that, well, if you want to transact on your commercial property at sale, you have to pay capital gains tax on it. But if it's your principal place residence, there's no capital gains tax. So, to this case study or scenario, you probably get one good crack at it.
Yeah. And you'd probably hold that commercial until you die.
This is the point. So you get one good crack to either get a capital gains tax exempt sale of a principal place of residence, parking, commercial, and then rent. And I think you're going to get more people renting moving forward, purely because it's becoming more democratised, the idea of long-term rents or build-to-rents and all this sort of stuff, right? Yep. So it's good for cash flow management. But the numbers work.
It's compelling. It's a 200 grand difference in that circa 5 mil price point. And the higher you go up that scale, like you can live like a king or queen if you're trying to rent a $10 million property. Like I was renting before we bought our house, right in one of the best streets in Bondi overlooking the beach. And we were paying similar numbers to that, like rent-wise, and the unit was probably worth 6 or 7 mil. And that had all the giant strata fees on top. So that would probably another 20 or 30.
Yeah, God.
Like the poor owner, what were you thinking? They're obviously got more money than sense to lease that out. And it's always been a leased property. So, it's strange how some people, invest, and generally they're the ones that don't have money issues. So hats off to them, good luck to them. But if you're starting to invest, buying a house where you've got that 200 grand negative cash flow position, and obviously you're not buying a 5 mil house, it might be 3, but the numbers still work in your favor.
It's all relative.
Yeah, it's all relative.
It's all relative. Yeah, and it's good to give that. So what you're talking about, there's this term of rent vesting, which I've never liked the term. I don't know who invented it. I've sort of spoken about it probably 7 or 8 years.
It's just a thing to go.
I don't like the term. I think it's a bit silly.
The main message, rent money is not dead money unless you're not investing. So
this is the point.
Like you have to invest. If you're just renting and doing nothing, it's silly because you're missing out on so 8 years we rent invested from our first time. But we wouldn't have got to the similar cash flow until probably 2022 after a few more big
Back to the point, you couldn't do both. you couldn't have a nice big family home and all that sort of stuff and grow a portfolio at the same speed at what you did. So you had to choose one over the other.
Yep.
But it doesn't need to be a permanent decision. That you chose that decision for a period of time with a view towards this decision. And now probably you can do both, right? Because you've got so much muscle in the property investment portfolio that can ameliorate any challenge or issues you have in cash flow inside of holding a large principal place of residence.
Yeah.
You know?
And the trick, like, obviously, I'm in a different position with businesses supporting our loans as well. Like, so we've just, again, like I was trying to protect myself. What if world caves in? So I sit at lower debt levels. Like, we could easily go out and buy a bunch of properties, but the principal place of residence is a riskier debt because no income on it. Like, sure, it's great if we sell it because there's no capital gains tax and stuff like that. But are we there to not sell?
Somewhere.
Like,
yeah.
it's sort of, it's just tied up equity.
And this is when you need to disconnect property investing with the emotional connectivity of a home to live in, right? Like, it's often quite hard. Well, people who are property investors sometimes struggle, myself included, with the conflict of it all, where you just go, well, it's nice and it's cool and, all this sort of stuff. But
But I used to love renting as well. Like, for me, I always like to feel like I'm on the move, and something about renting a better place every 2.5 years or 3 years, it was
But
exciting.
eventually you just go, I don't want to move anymore.
Yeah, you get the shits with
pack
moving.
your crap up
Yeah.
and sort of move it and all that sort
All
of
your
stuff.
furniture gets destroyed, all that. But look, there was a greater good to it. So, I wouldn't change anything. I would, I think it was important, that 8 years of rent vesting for us. And if we didn't do it, we'd have probably half the portfolio we'd have today. So it would have made huge financial
Well, that's the choice you had to make, and that's okay. But you're mature enough to be able to make those choices, or maybe had the awareness to be able to make those choices. A lot of people don't get the opportunity to make those choices because they just don't know about it.
Yeah.
Right. Hence the reason why we do podcasts like this. And just get back to data for a moment. I take your point around data, and there's a number of different ways you can frame and approach data. My view of it is that it should be an enabler for decision making, but it shouldn't be the panacea for only decision making. So, data's going to give you information. You need to be able to interpret. You need to be able to synthesize that and interpret that data in order to make an informed decision. If data's telling you what to do, you're probably doing it the wrong way. And a lot of people don't really understand or appreciate this because they think property investment is all data driven. Well, it is to a point, and it's going to help you maybe contain your searches or shape where you're searching for property. But there comes to a point where you need the actual ground truth of something. So this is the difference between information and the narrative and the interpretation of that, which supports decision making.
Yeah, and like a good example is people like seeing data where there's been a few years of good capital growth. For me, I actually don't like that because it feels like I've missed the run. A good example of data that can be skewed is if there's a suburb where there's a higher percentage of new builds going up. New builds sell for a higher value than an old house. So if you're I remember there was this suburb in Port Macquarie, they were building a new housing estate. 200 homes went in and there was 200,000 above the average median price. The data showed 60% growth over 2 years. So you got to delve into it.
You got to look.
Yeah.
You got to go and have a look. You got to eyeball it and go, okay, well, this is telling me something. What does it mean?
And generally when you see those sharp spikes, it shows there's probably going to be less growth in the future because the gas has run out. So that's a common sense way of looking at it. Sometimes it's good to find markets that have dropped in value for a couple of years, looking at, say, the Melbourne markets, but then you go, why did it drop? Is the change permanent? Is there any upside? Could things be, changed in a way where there'll be more capital growth, or is this a long-term trend because people are leaving the place? You got to really delve into the ground truth down there, and that's where you got to have the locals approach. What are owner-occupiers doing? That's one of the old school metrics, which the data is going to get clouded over because of the investor impact. The fact that investors can buy the entire market, let's use Townsville. There might be, a few hundred properties available over a 6-month period, but there might be the buyer demand from 2,000 investors. So they can buy everything 3 or 4 times over or even more, depending on the suburb. So got to be careful. Is the data, can it even predict where things are going to go now that investor behavior has changed to more short-term sugar hits? And then it'll go quiet for 7 years.
You've got to look behind the numbers and work it out because you've got to remember also with buyer's agency. There's a whole other aspect of being a buyer's agent. That's for owner occupiers. That because this is about property investment, doesn't largely get spoken about. Do you ever do any owner occupier stuff?
Oh, no, it's too
It's a different
cliquey.
game.
Yeah. Like there's a great market, and they were some of the original buyer's agents as well. Like, would I use one? Like, I don't know. I would consider it, even just because I can't be. I just want access to off-market deals, and they've got to be true off-market. Like, if I was going to buy a family home in the eastern suburbs or likes of Toorak, like if someone could give you an off-market deal, that has a big advantage because there might be 200 buyers looking for a house in that suburb, and only 2 or 3 a week come up. Got to jump the queue somehow.
But that's what happens on Lux Listings Sydney, is that right? When are you going to go on that? Are you going to go on Lux Listings Sydney?
Commercial's too boring for TV. Don't worry about that. I'll never be on that.
Nah. But we'll round out with that, and how do you, because most people think Scott O'Neill, who's a commercial guy, do you spend as much time with your head buried in sort of resi property deals and looking at online and all that sort of stuff as commercial?
Oh, look, I love commercial. Like we're by far the biggest and I think the best in the commercial space. Like we've got a market which is a lot higher barrier to entry, and I like that business aspect of it. The residential, I hate to admit, I did get a little bit bored by it. We were doing, even back in 2016, 17, we were doing 50 houses a month in these areas. So like after doing that, and I was on the tools, on the coalface, negotiating the deals, dealing with the clients, I did flake out a bit, like it wasn't exciting. Didn't care about the money that was coming in from the business. It was just repetitive. And I know you've had your similar things with business. I wanted to keep it fresh, but I really got more excited with the commercial because I saw there was more upside with it. But now something's changed in the market where commercial's now got in the higher price points. Like you can't buy a good commercial deal under 500 grand like you did 5 years ago. Yeah. Those same deals are worth $1 million plus now. It's
hard to find good $1 million deals now, right? We spoke about this last time we got together.
Exactly. So now residential is becoming more important from a business strategy point of view because we still want to help the middle class get into the upper ends of society. And to do that, you need to invest in residential. Might be 2 or 3 or 4 houses, but then you don't keep flogging that horse because like we said, you'll run into a brick wall and you won't retire. You're just going to accumulate debt and then hopefully you can survive the debt if things don't go right. And that's where commercial becomes important. But as the barrier to entry gets higher for commercial, the scope of the residential importance increases. So, yeah, we've always been in that space. I've been doing it since 2015 at pretty high volumes. We've bought in every state in the country. We love it. I've seen incredible growth results. Well,
I've met your team across the resi side of things, and you've built a very capable team of professionals that know this stuff inside out, and you're very process driven, operationalized, and that means that property investors get all the advantages of those years of experience doing resi transactions.
Most of my team are semi-retired investors. Like residential, one of the guys in there's he was a high-level developer, made a heap of money in that, bought a bunch of commercial properties, doesn't need to work anymore, but does residential because he loves it. There's residential valuers in there. There's just people that have done it, and they just want to sort of sit in the background. They don't want to be public about any of this, but they love helping investors just do well. And I'm almost the same. I get the thrill out of helping an entry-level investor almost more than dealing with a high net worth because the ego's a little bit less. Like that's something anyone that's spending over $10 million has a lot of ego, and we love dealing with that. It's a challenge, and the challenge when you're buying a 10 million plus commercial property is there's an ego on the other end. So we're like psychologists in the middle of it trying to deal with two titans trying to smash each other. In residential, there's less of that. It's just like, let's just get a deal because I want to buy a house. I want to get ahead in life. It's simple. It's nice. It's wholesome. And yeah, that's why I never want to lose that side of the business because it's how, my wife and I started and got there. Like you start small and build into bigger things, and that's how everyone will do it unless you get a big handout, which you don't see many people get big handouts anyway.
Doesn't often happen, right? You've got to do the hard work to actually manufacture it. So, which you've certainly done, and Rethink Investing is very much an exemplar of how, this. And back to the original point around the maturation of this industry in this sector. Organisations like yours, I think, are certainly the pin-up of how it's going to look like moving forward, highly reputable and capable and process-driven organisations. And I think that's what the future of buyers agents is. So thanks for coming in, mate, to the Smart Property Investment Show. We normally talk commercial and inside commercial property, so it's good to get you back on.
Got a little bit of it in there. So
yeah. Everyone talks about it.
No, it's good to be on the show. And I think it was 8 years ago I first came on this show. So
do you remember our first chat? We should go and tune. We'll go and tune in.
No idea what we spoke about. Yeah, be embarrassed to hear probably.
Probably. Yeah, it's so long ago. But thanks for tuning in, everyone. I hope you enjoy it. We'll keep at it. How long we'll do this show for, who knows? Good thing about property is that you can sort of keep pretty connected with it. It's probably one of those industries you can live in forever. I'm sure you see a lot of old-timer property investors who are 80 probably still doing deals, right? Happens.
Yeah, and they're the ones that own the big stuff. So yeah, you always upscale and scale up. That's sort of again part of the strategy.
So I'll conclude with this. So like you're 80-year-old property investor who's still got a lot of hunger and mongrel in them.
Yep.
Like what makes them tick, do you think? Is it still?
Good question. Like they just want to be relevant to a degree. Like most pub owners are quite elderly, and you could imagine like running a business like that. You've got to be very competitive. You got to love working with people because look, they say one of the ways to increase your life expectancy is keep working. Obviously, eat well and do all that stuff. But if you stop working, your life expectancy drops. But whatever it is, you keep that brain ticking, whether it's investing or working. Statistically, you'll live a bit longer. So
you reckon you'll be doing deals to the day you die? You reckon?
Yeah, just less of them. Like I'm all about the balance. Anymore, and what's changed for me in the last few years is I'm super content. Like I'm not trying to change, like do an extra 10% for the sake of an extra 10%. It's all about just long-term thinking and just getting better every month. And that's sort of where the business is at. And
it's cool. It's good.
Check the patch.
Well, you go and find these guys. Just Google Rethink Investing. You'll track them down, and there's lots of stuff. And once you scratch the surface on the Rethink business, you'll see a whole bunch of other things they're doing. And I'm sure Scott will be happy to chat with any of you around those sort of things. Rethink Group, is it .com.au? So what's
just Google Rethink. You'll see,
track them down.
Plenty of stuff.
Have you ever given a review to the Smart Property Investment Show?
I have.
Does any of your clients give a review to the Smart Property Investment Show when probably most of them have been introduced to your business through it? Not one review. So that's the challenge to you.
Targeting reviews on Spotify and that, isn't it?
Yeah, I know. But
it's good because it does help.
It's easy to do. Just on the Apple podcasting, just press review.
Yeah,
it's handy. Say, yes, Scott is really good. But please, reviews, please. That's all I ask for. Just reviews. That's what I'm told to ask for, by the way, by our team here. They say, you never ask for
what's
reviews.
A review actually do?
It just means that you go up in
pushes your
higher ranks. Like we get a lot of people tune into this, but we don't get any reviews. So the reviews are supposed to help more people find you allegedly. So we want more people to find you.
Definitely.
Hopefully it's making people make better decisions when it comes to property. Thanks for tuning in. Remember, smartpropertyinvestment.com.au. Find us on the social media. We're there as well. We'll see you next time. Until then, bye-bye.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.